If you're tired of losing trades, tired of second guessing all of your entries, and tired of searching for something that actually works, then this video is for you. I'll be breaking down the ultimate smart money concepts guide. These are the exact concepts that helped me go from a regular losing trader to a confident, consistently profitable trader who trades hundreds of thousands of dollars. So here's what you can expect in this video today. I'm going to walk you through 3 core lessons that are at the heart of mastering smart money concepts. And they are as follows: liquidity, supply and demand, and market structure. And then I'm going to piece it all together into a step-by-step trading strategy and walk you through a live trade example so you can see how it actually works in action. By the end of this video, you're going to be able to look at the markets in a way that you've never seen before. I follow a principle that I call KISS. Keep it stupid simple. And this one idea might be the very thing stopping you from becoming a profitable trader. You see, we're taught that anything powerful must be complex. The best paying jobs in society: doctors, surgeons, lawyers, years of study, difficult exams, high-level expertise. So it's natural to believe that trading should be complex. And that's where 99% of traders go wrong. The truth is, building a trading strategy is the easy part. And I didn't believe that when I started. I overcomplicated everything. I thought that more knowledge, more indicators, more tools would help me win. But it just made me confused. And I know that you felt that too. You follow these gurus who teach you 57 ways to analyze one chart and then wonder why your mind's fried every time you open TradingView. What actually works is simplicity. And that's what I'm going to be teaching you today. As a profitable trader, your only goal is to understand how smart money moves. These 3 core concepts, liquidity, supply and demand, and market structure, they're not based on retail gimmicks. They're built on first principles. The problem with most retail traders is they focus on effects instead of causes. Take something like a moving average. It shows you what has happened, not what will happen. But the market doesn't reward you for knowing the past. It rewards you for understanding intention. And when you really start to grasp why price moved, not just that it did, everything will change. As a retail trader, your job is not to move the market. You can't. Your job is to read the battle between the big players, the real money, and then align yourself with the side that's going to win. Because when they win, you win. So let's dive in to lesson number 1. It all starts with this one concept: liquidity. Because until you understand what liquidity is and how it's used, you'll always be the one getting stopped out of your trades, not the one who understands what's happening. When I first started trading, I thought the market was fair. I thought it rewarded logic, that good trades won and that bad trades lost. I was completely wrong. If you've ever felt like the market knows exactly where your stop loss is, you're not crazy. You're just finally starting to see the game for what it truly is. This market isn't random. It's engineered. And at the heart of that engineering is one powerful force: liquidity. Let's strip it back. What is liquidity, really? Liquidity is fuel. It's what institutions, the real players, need to enter and exit massive positions without moving the market too much. If you're trying to move $500 million into the market, you can't just hit buy like we do. You need a counterparty interest. In other words, you need other people to be on the wrong side of your trade. And that's where manipulation comes into things. Other traders are so obvious and predictable in their behavior. You have to understand that you're not the target because you're wrong. You're the target because you're needed. Imagine this. Price is pushing up into a key area of resistance. Everyone online is calling for the short. It looks perfect, textbook. And then boom, one final spike up. Everyone gets stopped out and the market melts in the original direction. What actually happened? The market grabbed liquidity to fuel the real positions. Once you actually understand this, you can stop trading with the herd. You stop looking at the chart like a retail trader and you start asking the right questions. Where is the liquidity and who needs it? Because the market doesn't move on your signal, it moves on their intention. Let's use this price chart in front of us to understand where the key, most common areas of liquidity can be found in the market. Let's start with the simple things. How about old highs and old lows? Very, very easy stuff. What you want to be understanding is that everybody, including myself and other traders, they use old highs and old lows as areas to protect their positions and areas to take their profits. It's what most people use for their take profits and also their stop losses. So what you can understand is that every old high or old low that you see sticking out of price, you can bet there is a bunch of liquidity at those levels. And why is that? Simply put, to understand liquidity, all it really means is fuel, as we've already covered. So if you look at a position, liquidity is money in the market. So every time that you get tagged into a trade, that liquidity flows into the market. Every time that your stop loss gets hit, that liquidity from closing that position gets flooded into the market. Every time your take profit gets hit, that liquidity of buying or selling that position gets flooded into the market. Those are the points where liquidity enters the market. So it's not about just every trade you take. People think that liquidity is only where people's entries are. That's not entirely true, because you also enter the market when you take profit or when you take a loss. You're buying or selling in those moments, and that liquidity flows into the market. So think in terms of entries, yes, but also think in terms of stop losses and take profit levels. Old highs are key areas where many traders, including institutions, place their stop losses, place their entries, and place their take profits. Think about it for a second. If you're looking at this market right here, the buyers who are trying to buy in these regions are likely to have their stop losses protected at maybe this low or maybe this low, making this a large liquid area. The same as for sellers. When sellers are stepping into the market in this region, they're probably putting their stop losses above these high or this high in here. Again, making these huge areas liquid. And then you have breakout traders, right? The types of traders who are identifying lows and highs like this. And what happens is when price trades through this level, they execute sell positions in this scenario because they think that price is going to continue going lower. So they execute their sell positions when price breaks through this level. That is also liquidity. And when they're selling that position, where do you think they're putting their stop losses? They're probably putting them above some highs like this. And then the same for the buyers, right? When you have breakout traders who are looking at this high here to be an area of resistance that if traded out of, they will use as a confirmation to go long. Well, they're going to be buying above this high. And where do you think they're placing their stop loss? It's probably going to be below this low, or below this low. And this is happening on all time frames at all times. So highs and lows are key liquidity areas, especially when you start to understand context. It's one thing to understand that a high and a low is liquidity. It's another thing to understand what liquidity is going to be there, who is looking at that level, and whose liquidity is available, entries and exits. When you can start understanding who's there and what they're looking at, that will take you to another level. Many traders with smart money concepts make the mistake of just spotting patterns. They're taking their same retail thinking of trying to find head and shoulders patterns or trend lines and applying it to smart money concepts, order blocks, equal highs. They're using the same idea as pattern recognition. That's why most SMC traders also fail. The reason is because they're using pattern recognition. What we use is context. We understand why this is happening. It's a huge difference. So now we understand highs and lows are extremely liquid in this market. We can also go into something a little bit deeper. How about other types of entries? Let's look example at support and resistance. So what we can see here on the same chart, the same price action, are different types of mines. Look at this level here, for example. This area here, you can see we trade through it, we come in, we test that level, we trade out of it, we come back, we test it again, we start trading out of it. So at this area right now, this is a key area of resistance, right? We have this high comes across, this high comes across, this high. Traders are looking at this as an area that price isn't willing to trade above. Therefore, that's a sell signal for them. So we understand there are perspectives in this market that are looking at this area as a perfect opportunity to sell. And so maybe they're already selling. Maybe they're getting ready to get in sells. What that simply means is we understand that this area here is highly liquid from sellers. So where are they likely to put their take profits? And where are they likely to put their stop losses? They're probably going to be putting their stop losses up here, and maybe they have their take profits down at this low, or maybe down at these lows in here. On the other hand, you actually have the buyers who are seeing that this is actually an area of support. You can see that we come into this level, we trade out of it with a large wick. The body closes up in here. We come back to this same area in here, and we respect it. We trade out, we come in, we trade out, we come in, and now we're back in here, and it looks like we're getting a little bit of a bullish reaction. There is probably also going to be a lot of buyers who are sitting at these regions. And where do you think they are looking to place their stop loss? Probably under a low like this. Where are they going to be looking to take their profits? Probably at the highs here, or above here, or maybe even above here. So there's another lens of understanding large clusters of behavior. The thing is there aren't that many strategies to trade. There's support and resistance, trend lines, equal highs, candlestick patterns, and obviously some indicators. And indicators will also be displaying this same information. There'll be people that will be looking at their EMAs or their RSIs and still be seeing the same things as these support and resistance type of traders. So what we want to be understanding is the context around the market that we see. This is essentially knowing what's going on, knowing where everybody's positioned. We haven't even got to smart money yet. At this point, we're only at liquidity. We've got 2 more layers to go. The final piece of liquidity that's obviously available here is the trend line liquidity that is forming across these highs, right? Very obvious to see. We have a high, another high, another high, another high, another high that are progressively getting lower. With each respect of this trend line, more traders flock to get involved in this move. Then what happens? Well, as price gets into this level, now we understand that sellers are going to be getting involved. So there's a huge pocket of liquidity here. We have equal highs, we have an area of resistance, we have trend line traders that are all looking to short the market in this level. On top of that, we also have the buyers who are going to be looking at this level as a potential profit target. Now let's go one step deeper. Let me show you another form of liquidity. And in my opinion, one of my favorite forms of liquidity. If you've been following me for some while now, you know how often I use session liquidity. Very important for me. So days, weeks, and sessions, highs and lows have massive amounts of liquidity in them. So what we can see here, to be very brief with you, is in the blue box, we have Asia session. In the green box, we have London session. And in yellow, we have New York session. This isn't the entire London, isn't the entire New York session. These are the main windows that I like to trade. Sometimes I would take a trade a little bit later than this specific session. For example, this closes at 10 a.m. Eastern Standard Time, but we understand that New York session still has a lunch session and a PM session that can still be traded. But I'm always looking at these specific levels. So what you can see here is not only do we have this as an area of resistance, right? This overall area here is not only an area of resistance, it is also an area of session highs. We have London high from today, and we have the highest point of New York session from yesterday. So many sellers that were getting involved in New York session, this is where they were getting involved in, and this is likely now where their stop losses are going to be. Then also on the high here, we have a London high. Here we have a New York high, and then all the way up here, we have another New York high. So we have a bunch of session highs. We also have a bunch of daily highs, right? Highs of day. So we have the high of Monday here. We have the high of Tuesday currently being formed in this region as well. So a lot of liquidity just in understanding this one simple price chart, which if you were to look at this before, you may not have even seen these levels of liquidity, or may not even understood how to think like smart money. Because by understanding all the different personalities, all the different styles of trading, and then understanding what they are likely to be looking at in the market, you're able to see where everyone's at. And that's the biggest edge that smart money have. They also understand that most traders often act obviously and repeatedly with the same behaviors. And therefore they understand where the liquidity is. Now, why is this important? Well, smart money, like I already said, if they want to trade a $500 million position to go long, they are going to need a lot of sellers. And sometimes to get those sellers, if they aren't already available, they will manipulate price. And they may push price into an area where they know there's going to be a lot of sell liquidity, either taking profits and selling a position off, inducing sellers into the market, or hitting some form of stop losses. Depending on the context, all of these events can provide sellers liquidity into the market, which then smart money can gobble up all of that sell liquidity and match it with their buy liquidity. Why do they want someone else to take the other side? Why not just push the price higher? That could be a good question. Let me ask you a question. If you were trying to long the market from here, would you prefer to get all of your position filled at this price point? Or would you prefer to get 10% filled here, 10% filled here, 10% here, 10% here, 10% here, 10% here, and so on? So your average buy-in price is all the way up here. So this is where you want it to long. And by the time you get your full position in the market, this is where you actually averaged your entire order. That is a huge spread difference. And you see, institutions, they don't want to take that spread. So what they do is they will use other people's liquidity. And when there isn't any, they will create it. Now that you have a good understanding of liquidity, the fuel behind every move, we need to look at where those moves begin. This is lesson number 2, supply and demand. And we're going deeper than retail concepts. We're going into the actual footprints left behind by smart money. I'm talking about order blocks and fair value gaps. You hear these terms all the time, but what do they actually mean and how do you actually use them? An order block is the last point of accumulation or distribution by smart money before a significant move. It's where institutions place large orders, often disguised as consolidation or indecision, right before launching price in a direction. These zones show up typically as the last bullish candle before a heavy drop, or the last bearish candle before a heavy rally. And they're powerful because price often comes back to these zones to rebalance or reaccumulate. Now, right next to any good order block, you'll often notice something called a fair value gap, or FVG. This is the imbalance created when price moves so aggressively that it skips over levels of fair value. In simple terms, it's a gap between wicks, usually between candle 1 and candle 3, where candle 2's body aggressively displaces price. Something you have to understand is that the market's primary objective is fair value. The more accepted a price level is, the more liquidity that is traded in that level, and therefore the more money that a market maker makes. So when price creates imbalances, fair value gaps, the market has a tendency to fill them in certain conditions. And here's the beautiful part. Order blocks show us where smart money is positioned. Fair value gaps confirm their presence. One is the base of the move and the other is the trail. When price breaks structure and leaves behind both an order block and fair value gap, that's your high probability level. This is where you want to be looking for trades, in the space between cause and effect, between intent and reaction. The problem with most traders is that they chase price or wait for indicators to tell them what's already happened. But smart money leaves clues in real time. If you know how to read those clues, you don't need 1,000 tools. You just need a clean chart, a sharp eye, and an understanding of intent, imbalance, and supply and demand. Think of it this way. When a whale makes a splash, you don't always see the whale, but you do see the ripples that it leaves behind. Order blocks and fair value gaps are the ripples. They're evidence of a presence. And in trading, that's more valuable than prediction. Let's take a look at this same price action to understand here supply and demand. First, let me kind of explain something to you theoretically. Imagine now, for example, you have a bullish market. Market is bullish. Price comes down into this level and then it begins ranging, right? So what happens in this range is it provides the perfect opportunity for a smart money entity to get involved in price. Like I said before, if you want to buy $500 million worth of euro dollar, you can't just buy because it will take price all the way up here and you'll get in your average order somewhere in here. That's less than optimal. So these institutions have strategies, and one of them is partitioning their positions. So they spread them out. Imagine taking $500 million and then spreading it down into very small receivable orders, Maybe they're little $5 million fragments, right? And 100 of them, for example. Well, now what you can do is when you see the opportunity where price is beginning to range, what essentially is happening here is a battle between buyers and sellers. This is what we call fair market value. This is an area of price where both buyers and sellers are clearly agreeing on price. And there's a lot of trading volume in this level, and yet the price isn't going higher and it isn't going lower. That's the perfect area for smart money to get involved. And here's what they're then able to do to position it. So what happens is when the market is ranging like this, all of these sellers, right, that are trying to push price lower, their liquidity comes in, and then this person who's trying to get all of their orders in, when this sell side liquidity comes in, they absorb it, they match it. So, imagine $20 million worth of sellers come into the market. This one institution can sit there and gobble up all those $20 million worth of sell orders and match them with buy orders because every buyer needs a seller. And then they filled 20 million of their position. And then what happens is those sellers that sold there, they become exhausted. So the buyers begin to take back control of the market, and then sellers step back in again. A new batch of sellers, maybe the same sellers. They go again, trying to take out these lows. It's a battle. Maybe another $20 million comes back into the market, and that same institution is there absorbing all of those orders. So now they've got $40 million without having to move the market. And then what happens is once all of those orders have been taken, they've been absorbed, there's no more sellers. So the sellers become exhausted, and then buyers step back in, and maybe sellers go again. And this is why you get this range-bound price delivery, because the market isn't going in any direction. And the likelihood is that one side of the market is trying to take price lower, and there's an institution, an entity somewhere who's just absorbing those orders to get involved in the real move. They're positioning themselves because they have a bias of some nature that price will eventually trade higher. And so they absorb all of those orders. And then what happens is at some point in time, when it's clear to see the sellers are becoming completely exhausted, nobody wants to attack the lows anymore, that is where smart money will essentially enable the market to go. And it will stop trying to position all of its buy orders in there, or maybe it will position some of its buy orders in there to take out this high level in here so that the sellers become absorbed. Nobody looks at the market now and believes that they should be selling. And at the same time, the market flips its sentiment and all the buyers come rushing to price, and everybody now is extremely bullish on the market sentiment. And so what happens is nobody's selling, but a lot of people start buying. And so obviously price goes higher. That's why sometimes it can take, $50 million to do a 100 pip move and $500 million to do a 5 pip move. The reason isn't that more money equals more distance. No. It's imbalance. How much more buyers are there than sellers? How many more buy orders are there than sell orders? That's what moves price, not how many people are active or how much dollars are traded. Supply and demand. The more buyers, the less sellers, the higher price. The more sellers, the less buyers, the lower price goes. And so always understand that. Sometimes you can get an aggressive move like this and you think that some huge institution is moving the price. Some context that may be true. It could also be that there's nobody willing to sell, right? And that's what they do. They will absorb in these areas, and this is where you see them positioning. And then after this positioning, that is ultimately when you see them move. Another example of this, what they'll do a lot of the time, the same scenario. They're trying to absorb all the sellers. But let's say, for example, there isn't enough sell orders coming into the market. Well, what they can do is they will just remove their buying for a moment, allow sellers to push price down, or even push price down themselves into an area like this that will make the rest of the market start being aggressively bearish, looking for lower prices, which does what? Floods the market with sellers, and then it absorbs all of those sellers when they come into here, and then they go. And so if you're a retail trader, or you've traded support and resistance before, or equal highs and equal lows, and you've seen these moves where there's an area of support here, and you're buying in here, and your stop loss is below here, and for some reason, the price just trades directly into your stop loss, and then rockets in the opposite direction, and you're left there just feeling like you've been abused by smart money, you're not all that wrong. It was intentional, designed to take liquidity. Now, is there someone there sitting and understanding that Joe's got a stop loss there? No, it's just common sense. If I understand it, I'm sure the smartest minds in the world know exactly what they're doing. And so that's why sometimes you see these ranges, manipulation, and then expansion, right? So that's what we really want to be looking for. That's the key point that we want to be identifying. So let's take a look at the current price in here. And let's kind of come out of this and we'll go back into price like this. So imagine that this is where price is. Price was aggressively overbought. And then what happens? price comes into a range. A range can be identified when price is just sitting stagnant in one area of price. This is where you can see the load up phase. This is where it's perfect for whoever wants to sell the market short in here, right? Whoever's selling price short is able to, when all of the buyers, because the market is bullish, all the buyers are coming in and they're trying to take price higher. Well, these sellers just absorb those orders, absorb them until there's no more buyers left. And then it's only sellers in the market and then price goes down. But what we want to identify is these ranges that occur just before the aggressive move that comes down. You can see that we have one big bearish candle. That's our sign. When you see a range and then a very aggressive sell move in here, that's your sign that smart money has entered the market. Now, not every order block and every fair value gap is going to work. That's a huge thing you need to understand. So many traders just try random order blocks or random fair value gaps. The key is context. That's why we're going to put in everything we learn into a strategy, because this information alone is useless. I can sit here and give you this all day long and you will still need me, because you will still need to understand how it all works together. It's like a big machine. It doesn't matter if you have one part of the puzzle or two parts. It doesn't matter if you have 9 out of 10 parts. If you don't have it all and then you don't know how to assemble it in the right way, it's useless to you. And so if you're someone right now who you feel like you've got a lot of these tools, you understand order blocks, you understand fair value gaps, you understand liquidity, you've got a good idea of a lot of it, but you're just missing on how to put it all together, or it just doesn't seem to work for you, I believe I can help you. Essentially what I have is a mentorship program. I teach people not only this, but way deeper than this, and not only the individual details, but putting everything together. In this video, I am going to be sharing with you a trading strategy, but this is just one of the trading strategies that I have. So if you're interested in taking your trading to the next level, and you think that you just actually want the hands-on help from someone who's doing it day in, day out. I have one student, Ralph, who just made $50,000 in the last couple of months on FTMO, verified with the QR. You can check it yourself. And he's been with me for 6 months because I'm hands-on with my clients. We have mentors inside of the program who are hands-on with our clients as well. And we get results. So if results are what you're looking for and you're serious about becoming a profitable trader, then below this video, I'll leave a little link. You can book a call with one of our team members and we can understand where you are and see whether or not we think we can help you. But let's get back to the video. So this is the range. And this final buy move in here, right before the aggressive sell, that's our order block. And the fair value gap is simple. We have one bullish candle, another bearish candle, another bearish candle. So the low of this candle right here and the high of this candle right here, that is our fair value gap. So we have a fair value gap and we have an order block. That is what it looks like in real time. But remember, just understanding a fair value gap or an order block alone isn't going to do anything for you. You need context, and we're going to be getting into that point. But for now, let's just go step by step. So there would be an example of a bearish order block. And how you do this, whether you use this candle, whether you use the entire range, that can be up to you, right? We have frameworks for that, but I won't go into the specifics here. I don't want to over confuse you. It can be stupidly simple. If we just play price out, price comes into this level, and then the likelihood is this level is going to now act as an area of resistance if it's contextual. Just because you have order blocks does not mean they will always work. Please, please, please understand this. Even look at this right here. We have a range. Price is aggressive, and then it goes 1 candle, 2 candle, 3 candles into this range phase. Look what happens just before the expansive bullish move here. We also get aggressive bearish candle that breaks down below these two lows like this. And then we have the expansive candle. This is, again, another perfect order block, right? And also has a fair value gap. The high of 1 and the low of 3, they don't meet each other. So that would be a fair value gap in here like this. There's another perfect example of an order block and a fair value gap in motion. You get the expansion, price comes back, respects it, and then continues, right? Again, context. It's not enough just to understand them. You have to understand how to use them. And like I said, that's what we will be getting into. So let's play price out. What do we have again here? As price comes into this level, what happens? Price stops. We start ranging. We get into this lower range phase. We have an aggressive buy here, which does what? Above these equal highs, which induces buyers so that what? So that smart money, so that the ones who are in control of price as of right now, they can absorb all that liquidity. Because on a lower time frame, when price is running aggressively, buyers are flooding into the market. They can absorb that liquidity and then use it. And then that there also becomes another area of supply. And we can see the fair value gap is the first candle, the second candle, and the third candle. The first and the third have a gap in between them. That's a fair value gap, right? Same thing again. So that's again another example of a bearish order block, right? You can see price comes into this level, respects it, and then begins trading lower. And so lesson number 3, we come to the king of context, the missing key that most traders never truly understand. And that is market structure. And honestly, it molds everything together. You can understand liquidity. You can mark out beautiful order blocks and fair value gaps. But if you don't understand the direction of the war, you'll win a few battles, but you'll always lose your account. Market structure is how you read the narrative of price. It's how you know whether smart money is accumulating or distributing, expanding or contracting. It tells you what phase the market is in, so you know exactly when to be aggressive, when to wait, and when to get out. At its core, market structure is built on one simple idea. Price moves in swings, highs and lows. An uptrend creates higher highs and higher lows. A downtrend creates lower highs and lower lows. A break of structure confirms a continuation. A change of character hints at a reversal. These are your breadcrumbs. They show you how smart money is shifting gears. Let's say you've identified your liquidity above some equal highs. You see an order block. You mark your fair value gap. That's all great. But here's the thing. If the structure isn't aligned, then the trade isn't valid. Structure is what tells you whether or not you should be entering this trade. It's your confirmation that smart money is moving in that direction. And now you can move in that direction at the right time with them. Market structure is like your direction, and your liquidity and your order blocks is like your areas of where you should execute and when you should execute. Most traders are blind to this. They're caught up in single candles, indicators, and signals, but price is telling you a story every day. And when you understand the structure of that story, you can stop reacting and start anticipating. Market structure gives you the when, the where, and the why. And once you have all of that, your strategy finally becomes complete. So let's dive into this. And then let's take all of what we've just learned and put it into a step-by-step, stupidly simple trading strategy that you can take away. So here we are on the same charts that we've been looking at this entire time. It's time to finally start understanding what the market is really telling us. In this example, actually market structure is overly simple. If you just zoom out of price like so, what you'll essentially see is a very obvious bullish move. And what we're seeing now is basically the pullback of this price leg. So what you can see here is an obvious low of price. Here is a swing low, right? We broke an old swing high that came from a macro event, and then we go and expand and we put in a new high. So basically we're contained within this range. We have a swing high up here and a swing low down here. If we go to a 30-minute time frame, it's exactly the same. Swing high is here, swing low is here, swing low becomes here, we break this high, this is our swing high. So our bias, our directional structure is bullish. Now that is, again, like I said, why this is so important is because you can know it all. But unless you understand which direction smart money is trading in, you're done for. So by understanding that the market is overall extremely bullish, now we can apply everything we just learned to understand whether or not we should be looking to sell or looking to buy. So now we can take everything we've understood and we can start mapping out our liquidity. Again, you can see here we have the buildup of the highs in here. We have this overall swing high all the way up here that we can use as a target as well. And then we have our internal levels. So we have London high, equal highs of New York. We have our area of resistance, right? So this is going to be a resistance level, a lot of liquidity above here. So we have another old high in of itself. We have another old high in of itself, right? And then a bunch of other highs. So all of these areas are liquidity, and we can map them out just like this. Liquidity, liquidity, liquidity. But we also have our sell side liquidity. We can't underestimate that. We clearly have these equal lows in here that essentially act as an area of support. So we have support bound liquidity as well. So this is liquidity as well. We also have, if you can kind of see it clearly, an obvious order block in here, right? That has already been partially mitigated. So for the purpose of this, it's not really that important. Then what we can begin to understand is our little internal swings. So if we go to a 15-minute time frame now, we can understand that again, if we zoom out, we're looking at the same picture, low to high, and then price coming down bearish like this. And then what happens? Price comes high, low, high, low, high, low, high, low, high. So we shift from being internally bearish to internally bullish. So now we have our external bullish, our internal bullish, and pretty much we are looking and ready to go long, right? Everything tells us long. Market structure tells us to go long. All of this liquidity can be used to be targeted because liquidity can also fuel a move, right? You have to understand that if there are sell side stop losses in here or breakout buys in here, if smart money wants to buy the market, then once it gets to certain areas, it doesn't want to keep buying price higher. It wants everybody else to do the work for them. And so all of this extra liquidity, all these buyers that step in, they are the ones that push price higher. And with the sellers being scared and exhausted, they stop selling. That's what enables price to go higher. And that's really what they're trying to create. So essentially what we want to be doing is waiting. Step one of our strategy, identify directional bias. When we come to the markets, we want to know, are we bullish or are we bearish? Overall, we are bullish. So our bias is to trade long. We want to trade long with smart money. Then I want to get down into my intraday. I want to understand what's likely going to happen today or what's likely going to happen tomorrow relative to this overall story. I want to identify all my liquidity points in price. And then I want to wait for key liquidations against me. So I don't want to be the trader who sees everything that looks amazing and then tries to long here and puts my stop losses down here when I understand that there's a bunch of liquidity in this level. I don't want to put my stop losses with that level of liquidity because I know the probability, the data indicates that price will take that level. So you just need to essentially wait for price. Price starts running higher. We come into these equal lows again, right? Price trades straight through those levels. Once this sell side liquidity has been taken, and as long as price is respecting this order block in here, or this fair value gap in here as well. Once price is respecting this level, the liquidity has been taken. Now we can look at expecting higher prices. And for confirmation, really what we want to look for is a clear displacement. So you can see now that price has got into this level, it's having a reaction, but we want to see a real bullish move that leaves behind an obvious fair value gap that we can then look at trading from. So if we look at this from, let's say, a 30-minute time frame, here's what it looks like. You can see here we have a bearish fair value gap. So I want to see the invalidation. Again, another very, very important point to understand is that when price wicks a low, so you see here price trades below this level and then comes back above that level, that is a clear sign of a reversal. Every time you see a high manipulated with an aggressive wick, the price reverses. You can look at it over and over again, right? You can see here we had some highs, we have a wick of a high, price then obviously reverses. Again, heavy wick on the buy side, followed by a reversal. You can look at this time and time and time again. I could show you multiple different variations of where price liquidates a high and then reverses. And I broke it down in other videos as well. When you see this sell side manipulation and a close above it, that's already a good sign. But I would like to see some kind of fair value gap, a displacement of this level. So we're holding this level, as you can see. This becomes a little bit more of an accumulation phase, right? We're holding this level. We continue holding this level. We're ranging at this point. Now, what do we have? Now we have the aggression. So if the next 30-minute candle maybe leaves a fair value gap of some kind, right, like this, there you go. There's your sign. Our overall direction is bullish. We're in a key area. We've taken the liquidity. Now the liquidity is up here. So the price is going to go from one area of liquidity to another area of liquidity. And if you see all of the liquidity is on the other side of the market and you are aligned with that direction structurally, you have an A+ setup. You just need to figure out how to get into that price action. And so what you can see here is very obvious. So we have our accumulation in here. We have our order block in here. We also have our fair value gap. So we want to be looking at entering, basically, we can look at this range in here, and then we can also look at the fair value gap. So we want to be looking at entering in this fair value gap. This is also a inverted fair value gap. So we've traded and displaced the previous fair value gap. We just want to be getting ourselves in the market. That's what we care about. Our stop loss is going to go at the low because a stop loss should always be an invalidation point. If price breaks down this low, then the whole idea of going long from here is invalidated. And if this low goes, this low is going as well. And then I don't know where we're going to see price go higher. But currently this low is what's in control of price. So I'm expecting that this low puts in this high, it comes back and we go and put in a new high. That's essentially a good area that we could look at taking a bit of our partials. 1 to 3 risk to reward. But overall, if you're looking at this price, where do you think price is heading overall? Price is heading overall toward this high. It's going to clear out all of this liquidity and target this high, because that is the structural understanding of price. That is why we understand that this is where we need to trade towards, because that there is our understanding of price. That's the structure. And that's what essentially gives us the finer details of our target. That's where the market is heading to. It's so clearly obvious. We just needed to figure out how to get in. That's where the small details of the liquidations and understanding where the liquidity is and understanding the order blocks, because we already understand where they're going. We need to now understand how to get in. And so this is one way to perfectly confirm how you can look at getting involved in the market. And so you can set fair value gap, cover stops at lows, and really what you want to be targeting is the highs in here, because all of this in here is a massive amount of liquidity ready to be rinsed and taken away. So you can see price pulls back. Again, mitigation of fair value gap, that's perfect reaction. That's exactly what you want to look at seeing. Into your fair value gap, out from your fair value gap, that's indicative of a solid area to be trading from. And then you just want to see where you can go from there. You want to be looking to get your stop loss at break even at some point, whichever point makes sense, right? For me personally, I'm looking at moving my stop losses to break even when we can logically shift highs. So that's a good indication. Boom, there you go. Now I can put my stop loss at break even because I understand that price shouldn't be coming back to my level now. If price is going to return to my level now, it's going to be going through this level, because now the new liquidity is at these lows. Because guess what? Everybody who's missed this move, guess what they want to do? They want to get in later. So now that this is the area of new support and the liquidity exists below these lows, which is what? Where my stop loss is. Yes, I can also be liquidity. That's why I have to make sure that I'm not there when the liquidity is available. I need to be already out or already moved to break even at the best. And so new liquidity forms here and people are waiting to get in, but there's also the people that are FOMOing into the market at this point as well. That's what's enabling price to trade higher. So you can see price continues to aggressively move higher. We have somewhat of a pullback. This is, I won't get into too much detail in this video, but this is where a lot of traders go wrong with psychology, right? Is like when they start seeing price coming back and handing them over some of their profits, they look to want to be getting out of the market. New York session opens. You can see we breached this high. Now we failed to break above this high. So we've liquidated this high, which at this point is pretty indicative that we may be looking to come and take out this low down here. And if we're coming to take this low down here, then price may start to pull back. At this point here, I want to be locking in some partial profits. I want to be closing some of this position just in case price ends up coming all the way back down, right? But not off of an emotion, off of logic, off of understanding how price is delivering itself. We've come into a lot of liquidity on the buy side. This entire move hasn't stretched all the way up to this specific price level in here. So I'm able to take off 3 risk reward at this specific price point, just in case price starts coming down towards here, because if price comes all the way down here, maybe it's going to end up coming back to my break-even point. My break-even point is inside of this level. So if we kind of just go down to a lower time frame, see how things start playing out, you want to always have eyes on as well, because is that low? This low goes down. Okay. So now what we're seeing is prices aggressively moving down here. This is going to be some kind of macro event. Let's take a little look. Cool. So what we can see is we're about to have FOMC at 2 p.m. So what I want to be cautious of at this moment in time is what happens during this FOMC event. I've already taken my profits, at least half of my position. I still have some profits left over, but at this point in time, I have no risk on the table. I'm break even on my position. My original stop loss is down here. I only have half the amount of risk on now. So as price is approaching this level, I want to look at seeing how I can approach this specific price point. I would like to make sure that my stops stay at break even because of FOMC and not trying to be forcing myself into this position. So there's FOMC, and during FOMC, I get taken out of that position at break even. So half of my position comes off here. The other half comes off with no win, no loss. So we take half a position. which is fine. It's risk management. We're still kind of hovering around this area. So you can see now we're starting to range in this new area of price. Still ranging in this area of price. So we haven't taken out this low yet. So it looks like we are respecting this area. Everything is still on. We still have this hourly fair value gap that's being protected. Price is ranging. Okay, cool. Now we have some expansion. The thing is this is an Asia session. So I'm never going to be trading this session. If I want to get back in this move, which could continue trading higher, I want to see what London session has to offer. London session opens with a very, very nice reaction. What does the next candle give us? The next candle gives us a nice fair value gap. We can try and get ourselves into the market inside of that fair value gap. Where can we put our stops? We're going to want to put our stops at a logical low and just continue riding this to the highs in here. So 1 to 2.35 risk reward. So we want to expand this to at least a minimum of a 1 to 3 risk reward. This needs to be at least a 1 to 3 to make any sense. Continue playing price out. See price continues trading. And at that point, it no longer makes sense to place that order. And so that position comes off the table. And there's the overall target hit. Now, was this a perfect trade? No. We didn't capitalize on the whole thing, but that's the reality of trading, right? Not every single trade is going to be textbook. There are going to be times where you maybe only get half of your position off the table and then the rest you tagged out at break even and then continue trading higher. The thing is, and what you don't do is you don't then get emotional and start deviating from your plan, which is what 99% of traders do. So the reality of trading is it isn't perfect. It's about doing what I've just done. Managing risk, assessing situations, making decisions that actually make sense. If you want to be able to do this consistently and do it with me every single day, then check the link down in the description, speak to one of my team members, and we'll see how we can get you to where you want to be.